Hey guys, it's NeoFX with Black Flag Trading. It's November the 3rd, 2018. It's almost 1 o'clock in the morning here in Texas, Central Standard Time. Today we're going to go over the dollar index, and I've had a lot of questions lately and comments as to what I think is going on with the dollar. So here we go. I figured I'd just make a video and give you my opinion of where we really are, regardless of what the public opinion is, and most importantly, if the outcome turns out to be correct, what you should do as a result in terms of investment and trades. Okay, so just spare a few minutes and let's go over this. So as you can see, the DXY is essentially the dollar index. This is the ticker symbol for the DXY is essentially it monitors the value of the dollar, okay, versus a basket of international currencies. Okay, that's all this shows you. Okay, you have euro dollar, you have pound dollar, you have whatever, Canadian dollar versus dollar, dollar yen, dollar Swiss. Those are currency pairings. Okay, that's the spot exchange rate for one currency to the other. Okay, if you want to convert, the dollar index just shows you the strength, the relative strength of the dollar worldwide as compared to other coins. Okay, so what do we have here? We have a period from 1985 to about 2001. Why am I showing this? I'm showing this because this is extremely important. You've got to know these patterns. You've got to be able to recognize them. You've got to put them into perspective, and then you got to be able to duplicate and mimic that same scenario over and over again. This is unbelievably important, what happened in this period in time as to what's going on now, and I will show you that. Okay, so what do we have? Like I always say, keep it very simple. This chart doesn't go further than 1986, but that's fine, because honestly this is literally all I need. So what is the usual routine I go by? Just those of you who know me know this very well. First thing first, determine the trend. I mean, you don't have to be a rocket scientist to determine the trend here, but let's do it correctly. Okay, so the trend was obviously down and we start carving out, but what is the best way? How do we become as surgical and precise as possible in how we know, in how we can tell what the bottom is? You know this. Every new low, okay, we had a low here. This was the correct trend line, and it's beautiful. It respects every lower high, then pulled back, and then guess what? We had a new low. So by default, we have to drag that trend line to this point right here. In other words, we have to connect the last high, okay, the lower high, because we're going down, before the last low. Okay, this would have been the right trend line in time. But then what happened? It broke out a little bit. This is, you know, this where everybody would have jumped in, because I mean, you know the crap that's out there, unfortunately. Okay, it breaks a trend or it goes above a moving average, and then say, you know, the next closing daily candle, you go bullish, you go up. Well, no, you don't. I'm sorry, you don't. What happened here was, this was a fake out. Okay, there was a fake breakout. We made a new low. So again, what do we do now? Well, same thing all over again. Okay, let's just connect these intermediate lower highs, because I think that'd be, it's more indicative of that medium term time frame. Okay, because that peak, forget about that. That's gone for now. If we're around this stage, okay, and if you don't know what's going on here, well, this is how you find out. What do I always say? The moment we break a trend line, could be down, could be up, doesn't matter, it works the exact same way. The moment we break, we're in a downtrend here because we have lower lows and lower highs, right? Up until this point. Well, guess what? We broke, and what do I always say? Instead of going long right away like an idiot, let it come back to the backside. Let it test the backside of the broken trend line. And then, if volume picks up, if we're at a Fibonacci number, which we definitely are. I mean, I don't. This looks like a 786. Okay, a little past it, but yeah, 786 retracement. Ideally, this extremely low risk to high reward trade, which is what I go for, would have been to buy this and exit the 127. That's the 127 is a natural Fibonacci extension and D target for this A, B, C, D, right? We buy that C, we exit that D. And then what happened? Well, then we just had another ABC form with a 50% pullback here. Perfect. 50% pullback. At this time, the moving average is crossed. In other words, we have another confirmation that we're going to probably go higher. Sure enough, we did. 50%. The 1618 will be the target. Sure enough, it went there. Okay. But more importantly, it's not just the fact that we magically figured out that this was the bottom, because if you really look a little closer, what you also see here, what you also see there is that we formed I mean, it's you know, it's not textbook, it's a head and shoulders nonetheless. Okay, it's a head and shoulders nonetheless. Left lower head, right shoulders. So you know that reverse head and shoulders, it's a bottom information pattern, and regardless, but you don't even need to do that. I literally just showed you with a break of the trend line and a retest on the backside of that broken trend line as support. That's where you buy. And guess what? If it goes against you, well, your stop will be right here. No harm done. But if it goes your way, I mean, you're going for a 5, 6, 7 to 1 risk reward, and that's the way you want to trade. But I digress. Let's get back to the chart and to the setup. What is this to me? To me, you know, if you would have been back in, what is it, 98, 99, 2000, everybody, I guarantee you, would have been bragging and just you know, praising the dollar, and it's been on a massive run, and it's gonna go up, and it's killing everybody else, and this and that. You know, dollar strength, that would have been the bias in the media, in Wall Street, whatever. Well, to me, it's the complete opposite. And not because I'm a counter trend trader, because I go both ways. That's not the issue. But to me, if you know what a Gartley is, and this is not a lesson on Gartleys, okay, but I will show you that to me, all this is a pullback, is a retracement to get to a certain level to then go down again. Okay, it's hard to picture when you look at this live that this will just go crash again, but to me that's what it is. Because look, once we go from swing high to swing low and then retraces, what do? Get your fibs out. We have our ABC point, our AB point, right? We are waiting for a completion of the C, and as it goes up to our C point to then sell again, because I mean, you know this, the ABC pattern is that we sell our C's, and if you go up, we buy our C's. But in this case, we're going down. So we sell our C's. But a Gartley, what a Gartley is, you essentially, on the way up to our C point, if prices also come up in A, B, C, D pattern and have those Fibonacci's align and converge at those levels, well, it's got a very high probability of completing that C point to then short. Okay, I know it's a little complicated, but I'm trying to keep it as simple as possible. In other words, the Elliott wave theory also has this incorporated, because the Elliott wave does this. The Elliott wave, essentially, we've got our 5 waves, impulse waves, right? Okay, and within those impulse waves, they have the ABC retracements. In other words, what that says is this: a correction. There you go, your correction wave. If from 1 to 2 or 3 to 4, the way it comes up, it comes down to that pullback, is in A, B, C corrections, well, this 2-point has a high probability of being support and being that, essentially, if you look at it in terms of A, B, C, D, being that C that you buy, that C level that you buy. Okay, it just raises the probability of this setup working out. Well, what do we have here? We had a beautiful, although extended, because it should have been the 618 if you look at this A, B, C, D. Okay, I hope I'm not losing you. Just follow me. It's very simple. All this bull run did is come to a point which will serve as a retracement of this leg, this A, B, C, to then go down to D, which will be lower than B. In other words, lower than this bottom. So to the typical trader or the unexperienced trader, this will be, oh my God, massive rally. Let me get in here, man. Let me get in. Look, we're making new highs. I'm sorry, I disagree. Where did that C completed at? Right at the 786. Well, let's see what happened. Let's see if my theory holds true in this case. Okay, let's fast forward from 2000 to 2000 and let's say 8, right at the financial crisis. Okay, guys. A, B, C, the D extension and target would be at 64 on the index, and the all-time low on the index was in 2008, right after the crash, the crisis, at 70. Guys, 70. In 15 years, we went from, well, 20 years, I guess, from 130 on the index to 70. 60-point drop. In other words, almost 50% crash in the dollar in 20 years. Okay, so keep this setup in mind. Let's fast forward. This was the bottom of the financial crisis. In other words, what happened here, the reason the dollar went up, has gone up this last 7-8 years like this, is because after the crisis in 2009, people flock to the dollar as a safe haven. That's it. That's the only reason. Because the dollar in this period under Obama should have kept crashing, fundamentally speaking, because we've been at zero interest rates. Anytime you have zero interest rates in the currency, it just crashes the shit out of it. But we haven't, because there was demand worldwide for the dollar as a safe haven. That's why we've gone up. That's why we've gone up. Okay? And all you hear now, the reason it went down here, by the way, 2001, 2008, we were under Bush. Crazy government spending. We had 3 wars going on in Iraq, Pakistan, and Afghanistan, obviously. Okay? Crazy government spending and money printing. Okay? And on top of that, massive tax cuts. So there was no revenue coming in for the government. That's what a Republican administration does. No tax cuts plus crazy spending. That's what it did to the dollar, as it should have. Okay, but look what happens now. Just like we had this beautiful textbook Gartley here, A, B, C, D, to then go down. Okay, that's the Gartley completion that then takes us south, and it did. Well, guess what, guys? This is exactly what these 10 years have done. This rally in the dollar, which I believe peaked last year at 104, we've peaked. We're going down. I'm not buying this dollar rally, guys. I am not buying it. The dollar is absolutely doomed. All it's done, it took a breather from this crash, came back up, but look at the pattern it came back up in. Look, I'm literally gonna transfer this shit over. The only thing is, I don't think we're gonna go as high as this went. We've actually topped here. And we should, because look where we're at. Look at the Fibonacci extension and retracement. A, B, sorry, right at the 618 last year. We peaked, bam. All now it's doing, oh, it's just retesting that C. So in other words, let me take the Gartley out. What we have, all we've done this last 10 years, we have come back to our C point. That's it. And our C, if the ABC is to hold true, will take us to lower levels than the B. Okay, the D has to complete. Typically, the AB leg is the same as the CD leg. We're done. That's it. That's it. That, in my opinion, the dollar is absolutely doomed. I could be wrong. The Feds might do something. I don't know. I don't know. The reason it's gone up a little bit these last few months is because interest rates have gone up. And the market is reacting the way it's supposed to, but it's momentary. Okay? Because look, all these 10 years, this shit should have tanked, because the dollar should have tanked because we had zero interest rates. Instead, it went up. Okay? So in my opinion, now that we're going to raise interest rates, it's actually going to do the opposite of what it fundamentally should be doing. Instead of going up, I think it's going to go down. Just like it did here. Instead of going down here at zero interest rates, it went up. Now that we're raising them, in theory, it should go up, but I think we're going to go down. Both fundamentally and technically speaking, the dollar's doomed. There's just too much fucking debt, guys. There's too much debt. It's $22 trillion of national debt. Trump just added another $1.5 trillion in tax cuts that we have no money to pay for. There's no money to pay for this tax cut, guys. So we're going to borrow that money. And the tax cuts is going to go to the upper 10%. Again, that's where tax cuts go. Okay, nobody feels a $300 to $1,000 tax cut. Nobody feels that, you know, for the average American. This is gonna benefit, as it always does, the rich. It's okay. It's all right. I'm not gonna get into the morals of it or politics. I'm just showing you what's going on. Textbook A, B, C, D with a Gartley pattern. Textbook again A, B, C to then go down with a Gartley pattern. We have topped last year at 104. Look at that. I mean, textbook right at the 618. We are going down, guys. We are going down on the dollar. They can try and delay it all they want, but they can't stop this from happening, because what's going to happen is the next recession, the next market crash in equities, they're going to have to intervene again for it not to be turn into a fucking depression. They're going to have to lower interest rates again. All they're doing now, when they're raising these interest rates, you know, as rapidly as they are, they're going to do another one in December and 4 more next year. All they're doing is they're trying to play catch up, because they've been at zero interest rates all this time. And the reason they do that is because that lowers their burden on their debt, on their treasury bonds that they sell to raise money. But they cannot keep that. So what's going to happen is they're going to lower interest rates again when the next recession happens, and they're going to let the dollar take the fall. It's one or the other. Either we go into a 15-20 year recession / depression next time around, or they're going to let the dollar take the hit. And they've done it before, time and time again. Look at that. 50%, 50%. Holy shit, man. They have absolutely no problem. As a matter of fact, it makes sense, because the dollar has lost 98% of its value in the last 80 years. So this is nothing new. Okay? The moment, listen, how do we know? You might be asking, how do we know when the exact time is? Well, listen, the moment this counter trend line breaks, guys, we're going down. We're going down, just like it did here. The moment the counter downward trend line, it's an uptrend, but it's a counter, you know, to the downside. It's a counter trend line to the overall bearish move. So the counter trend line, the moment this breaks, well, look what happened. So the moment this, and we're very close. We're very close because we have tested the line twice. Look, it's held perfectly so far, but I'm not buying this rally. I'm not. Could it retest this high? Absolutely. It could go to 101 again, or 96. I mean, that'd be quite a rally in the next few months. It could, but I'm not buying it because the C point has just been perfectly completed. Perfectly completed. Last year. Right here. So we're going down. We're going down. And if this pattern holds within for the next 5 to 10 years, guys, we're looking at 62 or below in the dollar index. In other words, lower than the last bottom in 2008. Because ABCD patterns always create a new low. ABCD, ABC is going to go lower. It has to. Okay? So look at this period, for instance. Look how other markets react when this happens. Just keep this period in mind. This was 2000 to 2010-11. Look what gold did from 2001, the same period that the dollar crashed. Gold went from $200 an ounce to $2,000 an ounce. Silver, 2001, bottom, okay? This bottom right here coincides with this top, all right? 2000, 2001. Look what it did in that decade. Guys, $3 an ounce, $50 an ounce. It's another commodity because commodities are typically go opposite to the dollar, right? It's a inverse relationship. So, what's the other one? Well, it's oil. WTI. Under Bush, 2000 bottom, $20 a barrel. By almost the end of the decade, $150 a barrel. And you can go on and on and on. So what does that tell me? That tells me that this pullback in gold and silver, which is counter, okay, which is counter to the recent uptrend in the dollar, okay, the dollar's gone up the last 6-7 years, and gold has gone down. That's exactly how it should be performing. That's the exact correlation. So what this tells me is that we're about to squeeze out a bottom here, because the dollar, I think, just squeezed out a top, a cyclical top. That's going to be your mid to long term, and I mean 3 to 5 year cycle, maybe more, play and thesis here. Gold, silver, some other commodities, and short the dollar. Long gold and silver. Fundamentally speaking, that's what you want to play. For more speculative investments, obviously cannabis is going to be huge. I've been talking about that in my service. And I've already given a few picks out, by the way. Some very, very strong companies at early stages with 1,000+% potential. Check it out anytime you want, guys, at blackflagtrading.com. Feel free to sign up or get the free newsletter. Just sign up for the newsletter. I send some free picks from time to time. But I'm just saying, guys, what appears to be an unbelievable rally, sometimes all it is just a retracement. This was an unbelievable rally here in and of itself, if you're in that period in time. But all it was a simple retracement with a Gartley pattern. ABCD, a little extended, but it's an ABCD nonetheless. That took us to our C point. So if we have A, B, well, that C will take us down. And fuck, did it. Yes, it did. Yes, it did. It worked textbook, textbook, textbook. And now it's doing the exact same thing. The exact same thing with a completion at a 618, which means that this fall could be even more violent than this one, because this one was very extended at the 786 of this. This is at the 618 of this. So my opinion, guys, I'm just not buying the dollar rally. I'm gonna stick to my original opinion. Dollar's doomed fundamentally, but even technically, as you can clearly see. I just showed it to you. Okay, in the next few years the dollar is gonna go down. So in other words, you'll want to buy the euro against it. I think we're about on the verge of breaking out. You want to buy, I don't know about the pound because of Brexit, but definitely Aussie, the New Zealand dollar, and you want to sell the dollar Canadian, because all we also did here was an A, B, C to the 786, perfect, with a Gartley pattern as well. Guys, we're looking at a 20-year chart here, and look at the surgical precision of this setup. A, B, C, textbook Gartley, and sure enough, it got respected, crashed, and now it's just playing out. It's just circling the drain is what I call it. It's just fighting. You know, it's doing what it can, obviously, but it's not gonna happen, guys. It's not gonna hold. It's not gonna hold. This charts don't lie. This charts, I just showed you 20-year perspectives, 25 years, and from 1985, that's what 30. What is that? 35 years. 33 years, whatever. 32 years of textbook repetition of the exact same pattern and almost with the exact same ratios. If this doesn't make you a believer, then I don't know what will. But again, trading and investing is about finding the next piece of the puzzle, and this is what I think is going to happen. The moment we break this kind of trend line and we're there, it's going to squeeze itself outside this a little bit and just come down. I don't know how long it'll take, but it'll come down. Maybe it'll come down with the market crash. It's supposed to. It's supposed to, but we'll see what happens. Okay, so that is my opinion. I hope you like this. Like it, share it, subscribe to the channel for more videos, guys, and we'll see you next time. Thank you.